Well, it certainly wasn't the result that the markets were expecting, but you only have to look at the global equity markets over the first 24 hours, having been down 800 points at one stage, only to rebound very significantly over the days following, to see that the markets have a way of adjusting to a new norm. Certainly we will have periods of uncertainty as we come to grips with what a new administration is necessarily going to mean, not just for the US economy, but for the global economy as a whole. But what is definitely the case is that if you follow through with Trump promises, that you will see greater expenditure, you will see lower corporate taxation, which could be inflationary and which could lead to greater US deficit. Necessarily, that could feed through into higher term interest rates. The third part of the equation is the Trump effect on global trade. And any renegotiation of global trade and its impact on sentiment, as we've already seen in spreads on emerging markets going forward. My own view is that this will take a long time to unravel, and that the US will naturally have to look at the impact on the US economy itself on a downplay of global trade. So we've got a lot of water to still go under the bridge. I think the markets can necessarily adjust to slightly higher rates. Emerging markets spread movement has probably been a little bit overdone in the short term. I think, if I may, one final point about sentiment in a rising rate environment, and that is that over the last few years we've seen a very significant amount of inflow from global investors on the hunt for yield. This has not necessarily just had an effect on investment grade spreads for investment grade credits, but it has also necessarily had an impact on emerging markets spreads and the maturity at which emerging markets credits have been seen to be able to drive issuance. So we've seen a significant increase in the amount of 10 and 30-year issuance over the last few years as that hunt for yield has become accelerated. In an environment where interest rates and spreads are moving negatively, I think there will be a significant pool of income which has only more recently moved into the emerging markets on that hunt for yield, and which could necessarily be redeployed into shorter maturity markets and into more safe haven markets. So as yields rise, I would expect a certain pool of global liquidity to be diverted away from emerging markets and into investment grade debt in shorter maturities. Well, overall, when we look at the supply dynamic, we don't actually think that there'll be a significant amount of difference in terms of supply through 17 versus 16. Obviously, what was encouraging from a capital markets perspective was to see the openness of the markets to a significant amount of supply coming out of the Middle East during the latter part of 2016. Those transactions were easily digested. Of course, in terms of asset quality, they come from a slightly different perspective to other parts of emerging markets being significantly investment grade rated. We have seen a resurgence through 16 in Russian and Russian-related issuance. I would be interested to see whether there will be any significant increase in that through 17 on any change in the dynamic between the US and Russia from a political perspective. So I think there is that to be encouraged about. But broadly speaking, I think we'll see a flat environment in terms of in emerging markets. Well, I think in the near term, unusually, we can expect the oil price to be the least volatile of those three. Certainly, given the current political dynamic in the US and the uncertainty over the Fed, and I would also add to that equation uncertainty in the Middle East and the direction of Chinese growth, I think we can fully expect volatility in the US dollar interest rate markets and naturally as a result in the global FX markets. I think oil is actually, I didn't think I'd be saying it, but it's the most stable of the three. The biggest issue around 2017 is the potential for the end of another bull market phase. And I say this not lightly, given the experience of other years ending in 7. So if you look at 1987, we saw the end of the 1980s bull run with the stock market crash. In 1997, we saw the dawn of the Asian currency crisis. And in 2007, of course, we saw the end of the greatest bull market over the last 70 years. So while we have seen a significant change in the dynamics of the global economies over the last 20 to 30 years, certainly years ending in a 7 always create a certain element of mystery and uncertainty for us to deal with. Well, I think even despite the increase in term rates in the US and the potential for greater uncertainty from a political perspective, a greater fragmentation of the global economy, it is nevertheless the case that the global corporate world is still under-leveraged from an historical perspective. And with interest rates the way they are and continue to be fed through global QE in the current environment, we would fully expect M&A opportunities still to be ripe for the taking, and we would expect cross-border M&A still to be at high levels. So I would expect corporate treasurers and boards to seize the moment, take advantage of the current low level of interest rates, which are effectively there through quantitative easing rather than a natural need for higher rates, seize the day, take advantage, and create significant amount of corporate activity. So that's really where I see the bright spot in terms of market activity. Well, I think despite the fragmented nature of the global economy and political uncertainty with Brexit and the US elections and obviously European elections still to come to create a significant amount more uncertainty, we still see a low amount of corporate leverage, a high amount of corporate confidence, low borrowing rates, and equity markets which effectively are defying gravity. So overall, the market looks like it's holding a glass which is definitely more half full than half empty. The markets want to have a reason to power on, and I think we'll see an increased amount of corporate activity. I think also fragmentation and less commoditization of the markets creates opportunity. It means that those that are close to their clients, that are providing good advice, good execution, can make a significant amount of difference. And that's what I'm looking forward to in 2017.